Kevin was 45 when 14 months of reactive trading reduced his retirement rollover from $67,000 to $49,860. There were no deposits and no withdrawals during that period. The direct account decline was $17,140, and Kevin still had 22 years until age 67. He did not lose every dollar, but the system had turned his long-term retirement account into a machine that demanded a new decision almost every day. That is the action tax. The action tax is the avoidable cost created when zero commission framing, continuous alerts, urgent market content, and one-tap execution encourage more decisions than a long-term plan requires. It does not mean every trade is wrong. It means unplanned action can repeatedly override the goal, time horizon, and risk policy the account was supposed to serve. In this video, you will see the three mechanisms that kept Kevin moving, the exact account ledger behind the $17,140 decline, and the firewall he built to protect the next 22 years. Kevin is a fictional composite. His income, account history, orders, and future balances are illustrations. The regulatory guidance and published research are real. Kevin operates a computer-controlled milling machine at a manufacturing plant in Akron, Ohio. He earns $51,000 a year before taxes. The $67,000 rollover represented about 7 years of overtime pay, holiday bonuses, and retirement contributions. It was not entertainment money. It was the largest long-term asset he owned. After changing jobs, Kevin moved the money into a self-directed brokerage account. The account advertised $0 online commissions. His phone delivered price alerts, market headlines, watch list movement, analyst changes, and social posts about stocks he followed. The app did not force him to trade, but it made trading immediate and made waiting feel like a decision he had failed to make. During 14 months, Kevin placed 412 executed buy or sell orders. Some trades made money, others lost money. At the end of the period, the account showed $49,860. Starting balance, $67,000. Deposits and withdrawals, 0. Ending balance, $49,860. Direct decline, $17,140, or approximately 25.6%. That ledger does not prove every trade caused the decline. It does not tell us what a passive alternative would have earned over the same 14 months. It does not permit us to label $17,140 as fees, taxes, or spread cost. It gives us one fact. Kevin's long-term account ended the reactive trading period with a smaller base. The first action tax mechanism is the zero-cost illusion. Kevin saw $0 commission and translated it into zero cost. Those statements are not identical. FINRA tells investors that zero commission trading does not mean free investing. Firms may earn money through margin interest, options commissions, service fees, and other parts of the account relationship. Order execution can also affect the price an investor receives. Investor.gov explains that a security can have a bid price and a higher ask price. The difference is the bid-ask spread. Its investor bulletin gives a simple exchange-traded fund example. If an investor buys 200 shares at an ask price of $60 and immediately sells at a bid price of $59.50, the spread creates a $100 loss. That is an example, not Kevin's cost. His true execution costs would depend on each security, order size, liquidity, timing, order type, and fill price. The zero-cost illusion is not the claim that every trade carries a large hidden fee. It is the mistake of treating a zero-commission label as permission to ignore every other cost and consequence. The second mechanism is the urgency loop. Kevin's watch list moved. The app notified him. He opened the chart. A headline supplied a reason. One tap converted attention into an order. Then the new position created another reason to watch. The United States Securities and Exchange Commission has described digital engagement practices that can include behavioral prompts, differential marketing, game-like features, and other design elements used to engage retail investors. The SEC has asked how those practices may relate to trading behavior and investor performance. That does not prove Kevin's app caused his loss or that every brokerage uses the same design. It identifies a real system mechanism. The interface can reduce the distance between emotion and execution. Kevin still owned the decision, but the environment delivered far more prompts to act than prompts to restate his 22-year goal. The urgency loop makes a long horizon feel like a sequence of one-day emergencies. The third mechanism is the reset cost. Kevin changed strategies 11 times in 14 months. He moved from individual stocks to sector funds, then options, then momentum trades, then defensive positions, and back again. Each new strategy reset the evidence he was using to judge the previous one. A landmark study by Brad Barber and Terrence Odian examined 66,465 households at a large discount broker from 1991 through 1996. The households that traded most earned an annual return of 11.4%, while the market returned 17.9% during that historical sample. The study does not predict Kevin's return or prove that every active investor underperforms. It is evidence that more activity has not automatically produced better outcomes for individual investors. For a late starter, resetting carries a second cost. There's less time to rebuild the base. Now look at Kevin's retirement illustration. Suppose he contributes $400 a month from age 45 to age 67. If the starting balance were still $67,000, a 5% annual return compounded monthly would produce approximately $392,561. At 7%, the illustration produces approximately $560,991. Now start with the actual fictional ending balance of $49,860. With the same $400 monthly contribution and the same 22-year timeline, 5% produces approximately $341,187. 7% produces approximately $481,396. The difference created by the $17,140 lower starting base is approximately $51,374 at 5%. At 7%, it is approximately $79,594. Those future gaps are not additional fees charged today. They are compound illustrations showing how a smaller starting base can affect two modeled futures. Neither return is guaranteed. Taxes, fees, contribution pauses, future losses, employer plan changes, and investment choices can materially change the outcome. Kevin could outperform either illustration. He could underperform both. Investor.gov's compound interest calculator uses a starting amount, monthly contribution, time, and an estimated interest rate. The word estimated matters here too. The reset cost is not a prophecy. It is the retirement pressure created when a late starter repeatedly gives long-term money a short-term job. Kevin's repair began with one important distinction. He did not promise to never act. Contributing, rebalancing, changing risk after a life event, meeting a cash need, and correcting an unsuitable investment can all be valid actions. He stopped allowing alerts and headlines to make those decisions for him. Step 1 was a complete account review. Kevin downloaded 14 months of statements and trade confirmations. He wrote down the starting balance, ending balance, deposits, withdrawals, realized results, unrealized results, listed fees, and every executed order. He did not invent a spread estimate and call it exact. He reviewed the fill prices and asked a brokerage to explain costs he did not understand. That blocked the zero-cost illusion. Step 2 was to break the urgency loop. Kevin turned off non-essential price, news, watch list, and social notifications. He removed market commentary accounts that existed only to create a new emergency every hour. He kept security alerts, account statements, tax documents, and messages that required a real response. The goal was not ignorance. It was to restore distance between a prompt and an order. Step 3 was an investment policy firewall. Kevin wrote one page containing his age 67 goal, 22-year horizon, $400 monthly contribution, target asset allocation, acceptable risk range, rebalancing rule, and scheduled review dates. Any action affecting long-term retirement money now had to answer 3 questions. Did Kevin's goal change? Did his time horizon or ability to accept loss change? Or did the portfolio move far enough from its written allocation to require planned rebalancing? If the answer to all 3 was no, a headline was not enough. That firewall blocked the reset cost. Step 4 was to automate the constructive action. $400 moved into the retirement account every month without a fresh decision. Investor.gov explains that asset allocation depends on time horizon and risk tolerance, and that diversification spreads money across investments to reduce concentration risk. Kevin selected a diversified allocation appropriate for his fictional situation after reviewing available products, fees, and risks. This script does not prescribe one fund or one allocation for every 45-year-old. Step 5 was a scheduled review. Kevin reviewed the account once each quarter and after a material life change. He compared the portfolio with a written policy, not with the loudest stock of the week. He could still act, but the plan, not the notification, decided when action was required. That is active patience. It is not neglect. It is a system that makes constructive action automatic and reactive action slower. Kevin's $49,860 did not return to $67,000 overnight. The repair did not erase the decline. It changed what controlled the next decision. If you are between 38 and 52 and manage your own long-term investments, write down 5 numbers: your current age, your target retirement age, your long-term account balance before the last 12 months, your balance now, adjusted for deposits and withdrawals, and the number of executed orders you placed. Then write one sentence describing what must be true before your long-term strategy changes. Do not assume fewer trades guarantees a better result. Use the exercise to identify whether your goal controls the account or whether the latest prompt controls it. For Kevin, the key number was not 412. It was 22 years. 22 years was the job at the account. One-day urgency had no right to replace it. The action tax survives when action is immediate and policy is absent. It weakens when costs are visible, notifications lose authority, contributions repeat automatically, and every major change must pass through a written long-term rule. But some people are not resetting an existing balance. They are trying to cross the gap between zero and their first protected dollar. That is the starting line tax, and that is the next mechanism you need to see.